Hi everyone, welcome to my YouTube channel. Tonight, guys, I want to take you through the derivative option pricing model. This is a quantitative finance project where I will be taking you through something called European option pricing. All right, under this project, first of all, I will take you through what is called the derivative, the financial derivative markets, and explain to you what do you mean by financial derivatives and how do we use these financial derivatives in pricing, particularly in the context of what's called the European options. All right, without wasting time, ladies and gentlemen, let's now start with the project. Number one, I will explain what we mean by what is called a financial derivative and what is the importance of these financial derivatives. Right, number one, a derivative or a financial derivative is a financial instrument. These are financial instruments, or we can call them the financial assets whose claims, whose value, whose value, or we can say whose performance are derived from the value, or the performance of an underlying asset. So this is called a financial derivative. A financial derivative is a financial instrument or an asset, financial asset, whose value or whose performance are actually derived from the performance of an underlying asset. So this is called a financial derivative. And these are financial assets. These include assets like stocks or equity. These include the debt, securities, or what is called the fixed income securities. And we also have things like commodity. We also have the currency in the exchange market. And then things like real estate. The other ones, we have interest rates. So these are examples of the underlying assets, which are actually its performance. We value the performance of a derivative by looking at the value of these underlying assets. And how important is these derivatives, ladies and gentlemen? Imagine when we have, let's say, it's just an example, we take a stock, and within this stock or an equity, then we add a derivative towards this stock. In general, most of the stocks are actually risky. Now, if we take this risky asset and we combine this with the derivative, we end up with something called a risk-free asset. So it's like having, it's just an example, it's like having a car or a vehicle, and within this car, then you insure it, you add an insurance on the car, then obvious, after adding an insurance, now you are going to have a risk-free vehicle. So you see that it's no longer risky. So these are examples of a financial derivatives. So financial derivatives, these are financial instruments or the assets whose values are actually derived from the value or the performance of an underlying asset. And in essence, we're actually performing something called replication. We're actually replicating the asset. Like, yes, this is the definition of a derivative. And now, what are the benefits of using these derivatives, particularly when you are dealing with the underlying assets such as the stocks or the bonds or the currencies or the interest rate? Right, the objectives or the benefits of using these the underlying assets are using the financial derivatives, such as the financial derivatives. Number one, it helps in the process of something called hedging. So it means the benefits of derivatives in the market. Number one is to mitigate. They're there to mitigate risk. They are there to actually reduce risk. They are there for hedging. And again, they're also used in the process of speculation, hedging and speculation. And again, they have benefits in the process of something called portfolio diversification. Portfolio diversification, particularly when dealing with the risk management. So these derivatives has a huge impact in reducing the risk, particularly when one is dealing with portfolio management. For example, assume like let's say you are an investor, or you are an advisor, and you need to advise an investor in like a client in terms of investing, like in terms of the initial policy statement of the client, looking at his or her income, looking at the risk tolerance of the client, whether it's a risk lover or is neutral. Then now, maybe in terms of the types of assets that you want to invest in. For example, you find that this person wants to invest into equity, want to invest into debt, securities. This person wants to invest into currency, is just an example. The person wants to invest into, let's say, interest rates, or wants to invest into real estate. So you can easily see that these different assets have different risk and returns. So in terms of looking at this, for example, if you look at the equity are high, they are more risky as compared to the debt security. But now, if you are advising a client and like looking at the correlation between these in terms of the portfolio, then when we talk about portfolio diversification, it's just a process where we use multiple assets in actually reducing the risk, in reducing the risk, reducing the risk, but by increasing the return. So this is actually called portfolio diversification benefit. So this, it has to do with, it means the derivatives, financial derivatives are financial instruments which can be used to actually mitigate risk. So we need to talk about these types of derivatives. And there are different kinds of derivatives, ladies and gentlemen, but in this section, I will only talk about derivatives called options. I'll only focus on options, which means options are other types of derivatives. So let me just talk about the types of derivatives, right? In terms of the financial derivatives, we have different kinds of derivatives. The first one is called a forward derivative. Second one is called a futures. Then we have options. We have options, and also have the swaps. But in this context, I'll only focus on something called the European options, ladies and gentlemen. And these European options, in other book, we call them the vanilla, options. So right, now let me talk about what we mean by an options and what are the examples of options in this project, ladies and gentlemen. Right. As I said, that we'll be talking about the European options, as I said, and under these European options, we have two types of options, which is called the call options and the put options. So we have call options and put options. But before I go into details about the call and the put, let me talk about what we mean by an option, a derivative option. What is an option? All right, an option. All right, an option in terms of derivative, an option is a financial contract, that gives the holder, you can call it the holder or the buyer or the borrower, that gives the holder the right, but not the obligation, to buy, which we will talk about, to buy or to sell the underlying, asset at a predetermined date agreed upon. So this is an example of, actually, this is the definition of an option. So an option is just a financial contract. We can also regard it as a financial derivatives that actually gives the holder or the user or the borrower the right, but not the obligation, to either buy or to sell the underlying asset at a predetermined date that it agreed upon. So this is called an option. So it gives the holder the right, or it gives the owner the right, but not the obligation to buy or to sell the underlying asset at a predetermined date that is agreed upon. So now these options, we have two types of options. We have something called the call options. We have something called the call option and put option. So there are two types of options. We have a call option and a put option. Now, the question is, because we know that the options provide, it's a contract that provides the holder the right, but not the obligation to buy or to sell the underlying asset, particularly at a strike price, but at a predetermined date that is agreed upon. So this is called the option. Now, since I said there are two types of options, so we have a put option and a call option. Now, let's differentiate between a put and a call. Right. In a call option, with a call option, the call option gives the holder, it provides or it gives the holder or the owner the right but not the obligation to buy, the right to buy. This is to do with buying, the right to buy the underlying asset. The underlying asset at a strike price, which we'll talk about it, at a strike price and at a time frame agreed upon. So it means under the call option, this option provides the rights to the user or to the holder to buy, the right to buy, but not to sell, the right to buy the underlying asset at a strike price. However, in a put option is the opposite. With a put option, it provides the holder with the right to sell the underlying asset. It provides with the right to sell the underlying asset at a predetermined date that is agreed upon. So you see that with the call, it provides the right to buy, but not the obligation. With the put, it provides the right to actually sell. So that is the difference between a call option and a put option, right? But in this section, in this project, we will only focus on what is called the European option, the European option. And in terms of the European option, we still have other types of option, which is called an American option. So we have a European option and American option. But in this context, we will only talk about the European option. So we have the European options and the American options. So the American options and European option. The only difference is that when you are dealing with American option, the American option, there are those options that can be exercised. They are exercised at the expiration date, or the maturity date that is agreed upon. So it means you can only exercise the European option only at the maturity date. But however, with the American have something called early exercise. They have something called early exercise. So it means they can be exercised anytime before the maturity date. They have early exercise. So you can exercise the option before the maturity date or just at the maturity date. So it has the option, so you can do that. So that is the difference between the American option and the European option, right? But now I want us to talk about what is called the European option in terms of the call price and the put price, right? Since I said the European option can be exercised only at the expiration date or the maturity date, or the expiration date. So this is what we'll be talking about. So now imagine we have the following. Imagine we want to compare the difference between a call option and a put option. So this is what I want to talk about. All right. In terms of a call option, remember we said call option provide the holder with the right to buy, In other book, they said the right to go long. To go long, it means the right to buy the underlying asset, whereas this one provides the holder or the owner with the right to sell or to go short, to take a short position. So, but we'll talk about this. Number one, in terms of the European call option, we have a formula for a European call. We say CT, which is a European call price, is equals to the maximum of the difference of the difference between the strike price, the spot price at maturity minus the strike price. Now we'll use K, or in another book they use X and 0. So it means the maximum between the two, either the difference between, remember ST is called a spot price. It's called a spot price. Then the K is called a strike price. So then the CT, this is called a call price, call option price. We just call it a call price at expiration, at maturity T, or at time T. So this is called the call price. But now, however, in the context of a put, with the put, it means it's the opposite of this. So with the put, we use the symbol PT, which is equals to the maximum between the strike price minus the stock price and 0. So you see that is the difference. So it means this is the difference between this. So now this is the formula for calculating the European call option at the call price at the maturity date. Then now, how does this work? Number one, if the strike price, I want to explain this. If the strike price at the spot price at period T is bigger than the strike price. If the strike price, the spot price, is higher than the strike price, it means the maximum between these two will just be S minus K, which means that when the strike price is bigger than, when the spot price is bigger than the strike price, we say, according to call price, we say we are at the money. This is at the money. So it means, in other words, when you are exercising a call option, you will only benefit when the strike price, when the spot price is bigger than the strike price. Again, it is possible that you find that the strike price is exactly equals to the spot price, it's exactly equals to it is no. no, at the money, at the money, it is when this are equal. I apologize. This is at the money. At the money, it is at the money here. Then now here, this is in the money. I apologize. This is when you are in the money, in the money. This is in the money. So it means when the strike price is bigger than, when the spot price is bigger than the strike price, this is called in the money. But however, if the strike price is less than, the spot price is less than the strike price, we say this is out of the money. This is out of the money. So it means, in other words, when the strike price is, when the spot price is below the strike price, this is not good for a call option, because with the call option, it will be out of the money. There will be no benefits in that regard. But when we come to this side, because this for a call option is just the maximum between the strike price and the stock price and zero, which means number one, when the strike price is bigger than, when the spot price is bigger than the strike price for a put option, this is not good for a put option. So it means this time around, this is out of the money. This is out of the money for a put option, but for a call option, it is in the money. But now, number two, when the spot price is exactly equal to the strike price, this is called at the money. This is at the money. This is called the at the money. However, even though it is at the money, it means the price at the money will be zero at the money. Then now number three, when the strike price it's less than, the spot price is less than the strike price, which means strike price is higher than this, then this is at the money. This is at the money. This is at the money. So you see that is vice versa. This one benefits when the spot price is bigger than the strike price. And this one benefits when the strike price, the spot price is less than the spot price. So in terms of graphs, we will say, if we were to talk about the options, then we'll say for a put and a call, for a call, as long as the strike, let's say this is the strike price at maturity, and this is just the call option. So which means for if this is the point where the strike price is equals to the spot price, so it means anything below will be zero, but anything above, then it will now be at the money. So the graph will look like this. This will be at the money, because this side, it is where the strike price is bigger than spot price bigger than the strike. But in this side is opposite. So it means anything below, that's where we have the highest. Then now this time around, this becomes zero. So it means it becomes into the money when the strike price, when the spot price is below the strike price. So this is into the money. This is for a put option, and this one is for a call option, ladies and gentlemen. Right now, but in this video, I just want to talk about the European call and put option using quantitative model called Black-Scholes option pricing. Black-Scholes option pricing. We still have other models which we'll focus later, but not in this video, which is called the Heston model calibration method, which we will talk about that in the other video. But in this video, ladies and gentlemen, I just want to talk about the European put and the European call options. All right. According to this, I'm going to talk about something called Black-Scholes option pricing model. Let me explain its functions so that we can be able to use Python in making predictions. Right, looking at this is called the Black-Scholes option price models. And in terms of its formula, according to the Black-Scholes option pricing, Black-Scholes and Melton's, they came up with these formulas of pricing a call and a put by using the differential calculus together with the stochastic process that has to do with Brownian motion. Right, according to the derivation, the first formula, it says C as a function of S, K, T, R, and sigma. This is equals to the S multiplied by N of D1. I will explain this, minus K times E times R, the exponential of negative RT times N of D2. Then also we have the C. C is a function of S also, K, T, R, and sigma. And now the formula, it starts with the K. So it's the opposite of this. So it's K times the E to the exponent of negative RT times the N of negative D2 minus the S times N of negative D2, which is just the opposite of this one. Now the question is, what is this C stand for, and what are the parameters inside this function? Right, then now again we have something called D1. D1, which is equals to the ln of the S over K. And this ln is just called the natural logarithm function. The natural log, then where we use S of S over K plus into R plus sigma squared divided by 2 times T divided by sigma the root of T. And also we have D2, and this D2 is actually computed by using D1 minus sigma times the root of T. We need to actually understand what we mean by, like, what are the parameters behind this Black-Scholes formula. Number one, we have C. C, it's for a call price. S is the stock price. P is the put price. K is called the strike price. The strike price, in other book, they call it an exercise price. It's called a strike price or an exercise price. And if you can look at the call, you see here is the stock price minus strike price. Like what I said at the expiration, according to the call, it is the maximum between the strike price, spot price minus strike price, and 0. You see, this is S minus K. So it's S minus K, which means for a put, it will be K minus S. So it will be K minus S. And these are actually adjusted. There are some adjustment towards this, so which we will talk about here. Then we also have the T. The T is called the maturity date. It's called the maturity date, which is the date at which the contract will actually expire. In other book, they call it an expiration date. It's called an expiration date. It's called the expiration date. Then we also have the R. The R denotes the risk-free interest rate. So it is a risk-free interest rate as a percentage. Then again, we have something called sigma, which is called the volatility. And in statistics, this sigma is called the standard deviation. It's called the standard deviation, which is actually a measure. It is a measure of risk. It's just a measure of risk. Remember, risk and return under the portfolio management, where, remember, the objective of derivation is to mitigate of derivatives, is to mitigate risk. We need to reduce risk by improving the return, reducing risk by improving return, which it also covered in the portfolio management under what is called the Markowitz portfolio. Right, we'll talk about that later, maybe in the other videos where we talk about the financial market. All right, again, ladies and gentlemen, we have the N. The N is called the cumulative distribution standard normal. It's called a cumulative distribution, which has to do with the CDF, where we know that when we are dealing with cumulative distribution function, we say the cumulative distribution function of variable X with its random variable. This is equals to the probability when X it's less or equals to that. But if we were to talking about the normal distribution, it means we need to standardize this. And to standardize this means we have to use the Z-score to say this is the X minus the mean divided by the sigma X. So which means by using the statistical function, we'll say the probability, I apologize, the probability when X is less or equals to that. Then if we are standardizing this, we are normalizing, this will be the X minus the mean divided by standard deviation. Same applies the X minus the mean divided by the standard deviation. So it means this will be the Z. This is the one that we use there. And this less than, let's call it maybe Z1. Is this an example? Now, if we want to get the Z1, the value, the cumulative distribution value, then we're gonna use this to say, since this is normal, remember what are we doing this? We actually want this Z, we want this to be normalized with a mean of 0 and a standard deviation of 1. So it means it shows that this distribution Z, it's normally distributed with the mean or the expected value of 1 and the standard deviation of 0. Standard deviation of 1. Then which means that we can do this, we can call this and say this will be the Z1. So it means to get the probability factor here, the probability factor, it means now in Python we'll use something called the norm CDF. So it will be the norm dot CDF of the Z1 together with the mean of 0 and standard deviation of 1. But this, there is no need to put this if you are using. But now it means we need to use, we must use statistical functions. We must use the statistical functions to actually compute that, which will use something called SciPy in Python. We'll use SciPy in Python. All right, this is called the norm distribution standard. Yes, I'm saying the cumulative distribution of a standard normal. So which means that again we have something called D1. D1 is the probability factor that will account for the expected stock returns. I'm saying stock prices if the option it's actually exercised. So the D1 is just the probability that actually accounts for the stock prices if the option is exercised. So, but when we have N D1, so it means this is the same as the probability when Z is less or equals to D1, which is equals to the psi of D1, which is actually computed by using the norm dot CDF with D1 and with the mean of 0 and standard deviation of 1, because remember we said the Z, it's normally distributed with the mean of 0 and standard deviation of 1. So we're actually standardizing. That is according to Black-Scholes option pricing model. Then again, this probability factor, which is called the D1 and D2. D1 is given by the natural log of the stock price divided by the strike price plus the risk-free rate plus I'm saying into the risk-free rate plus half times the square of the volatility multiplied by the maturity date divided by the sigma, which is volatility times the square root of the maturity date, and also this for D2. So we're going to use this function in actually making option pricing, making the pricing for a call or for a put to actually check whether we are at the money or we are in the money or we are out of the money, depending on the type of the option. Right. Again, we need to also talk about the assumption behind Black-Scholes. So it means Black-Scholes has its own assumption. Number one, according to Black-Scholes, they assume that the prices of these underlying assets are following something called a random walk, which has to do with, this is a stochastic process, which is a collection, is just a collection of random variables. So according to this, like according to Black-Scholes, they assume that the random walk, I'm saying the Black-Scholes formula or model undergoes something called random walk, which means that the price of the underlying assets, they follow something called random walk, which means the stock prices are unpredictable. You cannot predict them. So remember when we said these are just random variables, and random variables are quantities, are those quantities whose outcomes are actually uncertain. Quantities whose outcomes are uncertain. So quantities whose outcomes are actually uncertain are actually called the random variables. But according to this, we like in terms of the Black-Scholes assumption, it assumes that the stock price follows a random walk. And again, there's an assumption towards volatility. In terms of the Black-Scholes model, it assumes a constant volatility, which assumes that the volatility is constant and it's also known in advance. So this, according to Black-Scholes, to say the volatility of a stock price, the volatility of the stock price, it's actually known and it's constant and it's known in advance. This is the assumption. And again, he came up with the assumption to say the returns or the returns of these risky assets are normally distributed. So the returns are normally distributed with the mean of 0 and the standard deviation of 1, the mean and the standard deviation. This is according to Black-Scholes, but in reality, we might find that this is not always the case. Then again, according to Black-Scholes, there are no dividends. The risk asset pays no dividend during the option life. That is according to the Black-Scholes. And again, they assume a constant risk-free interest rate, to say the risk-free interest rate is assumed to be constant and it is known in advance. These are actually the assumption behind Black-Scholes model, option pricing model. So we're going to stick to these assumptions in order to make the predictions, ladies and gentlemen. Let's now start with the Python programming in order to predict the prices. Number one, I will import the necessary libraries. The first one is a Numpy, which is used for data manipulations, which will use it to call some functions like the logarithm functions, some of the functions that are important in order to use the mathematical functions. And we're gonna also import pandas. This is for reading data. However, we're not going to use it much here. Then we are going to also import the statistical function called stats, which is from something called SciPy. SciPy. From SciPy, we'll import the stats and we'll denote these stats as ST. So we're importing this in order to use, for example, if you want to calculate the standard deviation, so we'll just use st.sdev. So this is the function. This is a stats. So this we use this to call the statistical function. For example, if you want to calculate the kurtosis, if you want to calculate the kurtosis or the skewness value, so we'll use this stats function to actually import these statistical models. Right. Then now let's run this. I'm going to run this, ladies and gentlemen. So I will run the function. Then secondly, we will have to define the European call or the put option pricing using the Black-Scholes. So let me just explain what I'm going to do in terms of Python. So first of all, I just defined a function, and we call this function the European pricing. And this function needs the parameter. The first one is the list, and the second one, it is the type. So I will explain why I just created this list. So it means in terms of this type, I said for now, by default, I want to call this type to be a call option, So remember, we have two types of options. We have a call and a put. So now I will call, by default, now I'll just call it a type. Right, remember from the formula, we have this. Remember, in terms of the call price, its input is the stock, the stock price or strike, the spot price, the strike price, the maturity date, the risk-free rate, and the volatility. So I want to create this. I want to put them in a list to say, list these as the stock price, the strike price, the maturity date, the risk-free rate, and the volatility, and also provide the type of the option, whether you want it to be a call option or you want it to be a put option, but as a string. So in terms of the definition, I need to calculate the European call or a put price. So these are the parameters. So as I said here, S is the current stock price, which is a float. It means I want it to be in a decimal format. Then even the strike price to be in a decimal format. Maturity date should be in years. The risk-free rate as a percentage, the sigma, which is also a float, as a volatility, and the type, which is a string, either it's a call or a put. Then it has to return this option price, but formatted as a string. So it means we want to use it as an F string according to the definition. Right, we know, we've seen that from the formulas for a call and a put. Let's now define, here I just defined the probability factors. So here I just defined the probability factors, D1 and D2, using Python. We know that when we're using Python, the D1, according to Black-Scholes, is the natural log of the stock price divided by strike price plus the risk-free rate plus the half of the sigma squared times the t divided by the square root of the sigma times the square root of t, whereby D2 it's D1 minus sigma root t. So we want to first compute this using Python. So first of all, I'll call this D1, and now I'm going to use the Numpy to say non-log. So this is the natural log. I'll just use log of S divided by K plus the R plus the half times sigma, this is the sigma, but I want it to be squared. Remember in Python, if we say sigma, this is for times, but if you say you represent this now sigma to the power. Let's say if you put 2, this will be to the power of 2. So it means this will be sigma squared by using this. So that is what I've done here. So 0.5 times sigma to the power of 2, everything times T, which is the maturity date. Then now divide. Now I have to put everything inside the brackets. I have to put everything inside the brackets. So this is what I've actually done here. So it's a bracket here, and there's another one. So it's everything inside, then divide by the sigma. There is the sigma times the square root. So it means I have to use np dot square root, the numpy, to call the function for the square root of the t. So this is the square root. So it's sigma multiplied by square root of t. So again, we have to also compute the d2. The d2 is just the d1 minus sigma the root of t. So this is what I've done here, d1 minus, so I've defined the probability factors. Then after defining the probability factor, now remember we want to compute a call, I'm saying a call and a put option used for a Black-Scholes. So in doing this, I will use something called the try except block. In terms of the try except block, I will say, first of all, I want to come up, remember we have two formulas for the European option. So we have C as a function of S, K, T, R, and sigma, which is equals to S multiplied by the N of D1 minus K times e to the exponential of negative RT times N of D2. So which means in terms of this, ladies and gentlemen, I will say, remember, I will give an option to say, I want the type now. If the type is now a call option, then it must do this. But if the type is a put option, it means it must do the opposite. So it means the put option would be this minus this, but with the minus. So it means that is what I said to say. We say try this. I'm using try and accept blocks to say try this. If the type is a call, if the type is a call, then this is what it has to do. It has to calculate the call price. To say call price is the stock price multiplied by this. This is the function for the N D1, to say this is the norm dot CDF of the D1, which is normally distributed with the mean of 0 and the standard deviation of 1. So this is what I actually did there. But remember, we need to call the ST function, stats function, to say stats.norm.cdf, then the D1 with a log. Log is just saying with a mean of 0 and the scale of 1, but there's no need. We can leave this and also put D1. It will give us the same output when we are computing. Then now, and again, minus, we're doing this minus K times, we need to show the exponential. So it's going to be numpy times the exp. Exp is for exponential into negative R multiplied by T outside times the N, same so it's going to be N of D2. So it means it's going to be stats.norm.cdf, cumulative distribution function of D2 with a mean of 0 and standard deviation of 1. So we have now done that. Then it has to return the European call option, but it has to return this call price. But I've just used as an F string to say it has to return the European call price, which is rounded to 4 decimal places. Then again, otherwise, if it's not a call, it's a put, then it has to calculate the put price. It means I'm changing the function now. It has to calculate the put price to say if the type, else if the type it's a put, then now it has to calculate the put price. using the opposite of the formula. So it starts this side minus that. So it's this part and minus this, and do the same just to now return. Otherwise, if it does not get these two options, it gets something else. It has to raise an error to say it is an invalid option type. It must either either be a call or a put. So this is actually, it's a good practice, particularly when you are dealing with Python. So this is what I actually did. Now, then in terms of this, let's now run this. I need to run this so that we are able to observe like the result. So I'll just run this. Right, I have ran the code. Now we can remember. Now I'm doing this. I'm showing this as a list. So in other words, if you do not want to show this as a list, means you need to put all the inputs. You must put the S under this. Instead, you must write the S, the K, the T, the R, and the sigma inside the function. It also will give you that. But to avoid that, I've just created a list so that I will use it in computing. Then in the second code line code here, what I've done here, I've created a function to allow the user to enter the parameters, like to allow the user to enter the parameters using a built-in function called input function under Python. We will use something called an input function under Python, which will actually allow the user to input the parameters. Number one, here, what I've done, I just created an empty list. And what is the main aim of doing this? I want to create a list also that whatever I'm going to input, it needs to be appended, or we need to add it inside this list. Number one, we need to input the spot price. And inputting the spot price, I remember we said we want the spot price to be a float. So it means I'll say whatever you input, always it should be a float, it should be a decimal number. But it can also accept the integers, but it will not accept anything that is not a number. It will not accept it. So after that, after computing the spot price, it has to append this. So it computes the spot price. After doing it, then it has to add it inside the list. Secondly, it impute the strike price. It also append it. Then it impute the user must impute the maturity date. Same applies. It has to be appended. Then the risk-free rate, it needs to be appended as a float. Then the volatility, it must also be appended. And the last one is to input the type of the European option, whether it's a call or it's a put, but this one should be a string. It's a string because we want it to tell whether it's a put or a call. Then again, we need to print this list. Remember, when you print this list, it means inside the list, you must have the spot price, the strike price in that order, the maturity date, the risk-free rate, and the interest, the volatility. Then again, we need to compute this European call or a put, taking into account, remember what I've done here, I just called the function. I called the function. If you look at this, if you can look, this shows it shows the list and the type. So it's just the function that we defined. Now I'm calling it the European pricing that required the list and the type. So now what we're gonna do is we want to run this code block so that the user can be able to enter the parameter in predicting either the call or the put. But remember I said the call option, it's of value when the spot price is higher than the strike price. For example, if you look at this, if we just say as an example, we have a strike price, we have it's just an example. Let's say we have a spot price, a strike price, maturity date, risk-free rate, and the sigma. Let's say we want this to be all flowed. Let's say maybe the strike price is 100, the spot price is 100, the strike price is around 25, then the maturity date is just half year, so it's just 0.5. Then now the interest rate, let's just say it's 2%, which is 0.02. The volatility is just 1%, which is 0.01. So we wanted to actually look at this, guys. Since this stock price is bigger than the strike price, it means this will benefit a call if we were to exercise a call option. So for a call option will benefit because this will be in the money. For a call option, this will be in the money. It will be in the money, But if we exercise a put option, it will be out of the money. It will be out of the money, Remember, we said this is for a call and this one is for a put. So it means if the stock price is bigger than the strike price, this is good for a call option, but it will be bad for a put option. So this is what we actually wanted to actually predict whether will be in the money or will be out of the money. So let's run this code, ladies and gentlemen. In terms of the coding, you see it says enter the spot price. Remember our spot price there is 100, we just enter it as 100. Then we'll say enter the strike price. Strike price is 25. Then enter the maturity date. Maturity date here we said is 0.5. Then enter the risk-free rate. Risk-free rate is 2%, is 0.02. Then enter the volatility. Volatility is 0.01. Then now we want to, you see it says, what is the type of the European? It means you need to tell whether it's a call or a put. So we want it to be a call option. So for a call option, you see it says that with those lists, you see it has listed those inputs. You say yours with a strike spot price of 100. I'm say spot price of 100, strike price of 25, maturity of 0.5, interest rate of 0.02, and with the volatility of 0.01, then the European call price will be $75.2488. So which means this is actually a call price. If we were to exercise a call price, you see, it shows that it is in the money. It shows that if we exercise that, will be in the money if we were to exercise the call option. But let's now exercise a put option instead of a call option. I'm going to run this again. Enter the spot price is 100. Then strike price is 25. Maturity date is 0.5. The interest rate is 0.02. The volatility is 0.01. But this time around, we want to exercise a put. So let's run. You see, it says for a European put, then it will just be 0.0. Why? It shows that it is out of the money. It is not in the money, but it's out of the money, which means it will become out of the money if the stock price is higher than the strike price. But now let's change this. Let's change this, ladies and gentlemen. Let's assume now, let's say we do the opposite. We want the spot price to be 25. It's just an example. We want the spot price to be 25 and the strike price to be 100. You can easily see that since the spot price is less than the strike price, then this will be out of the money for a call and it will be in the money for a put option. Let's try this. Let's compute this to check that. So we're gonna run this. If we run this, then it will say enter the spot price. We'll enter the spot price. Then spot price here, our spot price is 25. 25, it is the spot price. So I'm going to enter to say it's 25. What is the strike price? Strike price is 100. Then what is the maturity date? 0.5. Risk-free rate is 0.02. Volatility is 0.01. But now we need to exercise. Let's start with the call. With the call option, you see it says that for a call option this time around, the European call price will be 0.0. But now let's do the running again. Let's do the running again. So the spot price is 25. Strike price is 100. Maturity date is 0.5. Interest rate is 0.02. Volatility is 0.01. Now this time around, we want to exercise, want to run, have a put option. You see with the put option, it says it's 75.005. 75.005. So you see that because of that, it now becomes into the money. It becomes into the money for a put, which means when having this, if the stock price is now lower, it is advisable to actually, it is advisable instead of buying this option, is advisable to sell. You sell the what? You sell the option at a higher price, then so that you are able to actually attain this. So it is advisable to sell this option. You sell the option. So you sell the option rather than buying. So you can buy if the stock price is bigger than the strike price, and it's good to buy. It's good to buy rather than selling. Remember, we said a call provides the holder with the rights to buy the underlying asset at a predetermined date, and this strike price. So you have seen that we can actually use Black-Scholes to actually predict the prices, the European call and a put, European call and a put. But now this time around, I need to create an app so that we are doing something called model deployment. We need to create an app that will be used actually to iteratively change these values in order to predict the price. So already, this is the function that I've already done, European option pricing app. So I'm using a Streamlit. So using it, I'm still going to use the same functions that I've actually shown earlier, but this time around, I want to create an app to say like first, we need to import the necessary library. Number one, I'll import something called Streamlit as ST, and I will import the Numpy and also import the stat function to also use it. But this time around, by defining a function, I'm no longer going to create a list. I'll just input those values. So S, K, T, R, sigma, and also the type. Then by default, I'll just call it to be a call option by default. So, but we can change this. So now, in terms of this, ladies and gentlemen, in the app, we need to do the same. So I'm not going to repeat this. We're going to define a function. Now, number one, in the app, we'll have to define the probability factor, like what I said there, probability factors, which we will use them in the Black-Scholes. I've already explained this. Now, even this code I've already explained. Remember the issue of saying log of 0 and scale. There's no need. We can even get rid of this. We just write D1 only. It automatically knows that it will be normally distributed with the mean of 0 and the standard deviation of 1. But it's actually advisable, or it's a good practice to show all the workings. But I can get rid of this. Let's just write D1 here and also D2 there. So now, in terms of my Streamlit, I'm going to create a main function that will use to display this option pricing, to print them. then already I've explained this. Then now number 2, okay, fine. Yeah, first we'll have to define by using the Streamlit function. Remember, ST here is our Streamlit. I'm calling the Streamlit. So in terms of the Streamlit function, we have the Streamlit title, which will use it to write the title of my app, and also what are my input fields. So the input here will create a sidebar. Under this sidebar, we'll have the input parameters, which you can call it the futures parameters, or you can call them the option pricing parameters. Then we can even call them the option pricing parameters. European, let me just call it the European option pricing European pricing parameters. Then now in terms of this, what I've done is just to say, okay, the S is for the spot price, which will input as a sidebar, but it is a number. So in this, I just said by default, I said we just take it as 100 by default, and the values will increase by 0.1. Then we also have this strike price, same applies by default, it's 100. The maturity by default, I'll just say it's just a year. And the risk-free rate by default is just 0.05, but with the step size, obviously. So it means I want this to increase by 0.01. Then the sigma by default is the 0.2. Then now I'll also have an input function type to select. This one, I'm just creating a box to say as a sidebar, select a box that will actually list them to list whether it's a call or whether it's a put. But you can see that the calls here, these are in caps. So it means in terms of this, we can use the lower function to actually lower everything to be in low cases. But even if we do not do this, I can still change this. Instead of not doing this, I can write them as a call or a put without being in caps. So now this is what I actually done here in the app. Right, you can also add your other features here if you want. Then now again, this is the function that I've actually used to actually call to compute the result, to say with the European pricing function. Within this European pricing function, the input should be the S, the K, the T, the R, the sigma, and the type, whether it's a call or a put, but in a lower state string. Then now again, this has to display the result. So what I've done, I just said st.subheader to create a subheader under this European option pricing app, to call it an option pricing result. Then it has to write the result. It must display the result, this result here, based on whether it's a call or a put. Then now under here there is a code block that I have indicated to say if the name is equals to the main, then it must write this. So what does this mean? This is a code block that is usually used to this is a good practice to say you need to write this in order to this will ensure that it will be able to call all the functions which are actually imported from another Python program. This is actually a good practice when you are dealing with Streamlit. Right, then what I will do is, we cannot run this function right now because we need to display this as a Python file. So what I will do is this, ladies and gentlemen, already I have created mine. Or what I will do here, we'll have to call this function. We have to call the function. Then after calling the function, now I'm saying we copy. Let's copy this. So I've copied the functions. Then now what I will do is, let me just go back, because we need to create a Python file we need to create a Python file. So here I'll just go here on the file path. So I'll just go to file on my Jupyter notebook here. Then I'll right click this file here. So once I click this, then I'll go to new, then I'll go to something called Python file. So I have to open this Python file, ladies and gentlemen. After opening the Python file, we actually wanted to create a Python file which will use it to run the app, So it's still opening this Python file, ladies and gentlemen. Let's just wait for it. Let's just wait for it while it's still opening. All right, remember in terms of our estimation, we got that we have 74.005 when we are exercising a put with a strike price of spot price of 25, strike price of 100, 0.02. Then now risk-free rate, volatility. And then now this time around we want to use an app. We want to create an app using Streamlit. To create an app that will be used, we'll use it to actually predict the prices for a call or for a put, depending on our choice. Right. So now while we are waiting for this to actually open, remember we have copied the function that we need to use under, like, to create an app using Streamlit. Still opening. All right. And now, so this is according to the Black-Scholes option pricing model. This is for quantitative finance derivative option pricing model. And yes, it has opened now. Let's now paste the function that we have copied from the other file. So now this time around, let's rename this. I want to rename this and call this Black-Scholes. Let's call this the Black-Scholes pricing app. Let's call this the Black-Scholes pricing app. So already on my side, I already created this, but I just wanted to show you how you, like, I wanted to show you how to do this. It has to be saved. Must be saved. I think it's still saving. Okay, let me rename it. Let's just say Black-Scholes pricing app. Black-Scholes price. So let's rename this Black-Scholes pricing app. But I've already created mine. Okay, let me just try to. Why is it taking time? Okay. It's supposed to be named already. Okay. But on my side, I still have another one. The one that is, so you see now here it says Black-Scholes. So I already have another app here. So I will just use this. Okay, it's fine. I wanted to create another one. Let's just call this. Why is not renaming? Black-Scholes app. Let's call it an app. Rename. Yes, there it is. It's Black-Scholes app. Then after doing this, we need to save this. Already it should be saved in my local environment. So you can see here, you see it shows here that it has been saved as a Black-Scholes app. So we need to actually download this so that we can save it in the local machine. Right, since I've saved it already, I'm gonna save all. And after saving, then we need to download it. Let's download. I'll download this. Let's go to download. So automatically it will be downloaded. Soon it will be downloaded. So you see it's still downloading here. So it's still downloading just here. So you see it says Black-Scholes app. So it's still now downloaded. Okay, fine. Now I'm downloading it. So I'm downloading the app. Where is the date is? So I'm gonna copy. Copy it. So now after copying, ladies and gentlemen, we need to save it in the local machine. I'll actually save it here in the local machine. Let me open this. So you see that already I have, there's another one which I had initially. So what I'll just do is I'll just, you see this is a new one. So I'll just delete this one. So let's delete it so that we can be able to, so let's delete this one. So, and rename, I want to rename this one. Let's call it the Black-Scholes app. And after doing that, I need to call this path. Let's call the path where I saved. Remember, I've saved the app in the local machine. I've already saved it in the local machine. There it is. So now I'm gonna call this. So I'll just call this path. So let me copy this file path. Created a short. Okay, let me delete this. Let's call this file path. I'll just copy this file path, copy it. Then let's now minimize this. After minimizing, then I will have to go to call the Anaconda. You can just call your Jupyter notebook. I'm saying Anaconda navigate. So I'll just go to Anaconda. Then I'll also open the Anaconda prompt. I'll just call the Anaconda prompt. So this is the Anaconda prompt, ladies and gentlemen. So if you can just check somewhere here, let me just try to minimize it. There's the Anaconda prompt. If you can look here, it shows that here it's just written the base. It shows the base, which is the local environment where I'm actually working at. So what I'll just do is I'll just go to this. Just a minute. So under this Jupyter, okay. Okay, let me zoom it again. Right. First of all, we need to write Streamlit. We need to call the Streamlit function. Streamlit run. Under Streamlit, then we put quotation marks. Quotation mark, then we paste the file path. Remember I said this is the file path where I've saved the app as a Python file. And then now after that, we need to run this. Remember, we need to run this Black-Scholes app as a Python file. So it means now in the, as a function, now I'll just do this. I'll just say forward slash as a forward, then I'll write Black-Scholes app as a Python file, py, then we put a quotation mark. So what I've done there, I'll just, you see, I've called this Black-Scholes app as a py file. So let's now go back, Black-Scholes as a py, then let's run this. So when we run this, it will automatically display the Streamlit app, the app so that we can use it in predicting the call or the put. So making the predictions of the call or the put. So let's just give it some time. It will display the results. It will actually display the results, ladies and gentlemen. So all the time, okay, it says Streamlit run help, require help. Okay, fine. Let's check. Streamlit run, then invalid file does not exist. So it says the Black-Scholes app, it says file does not exist. So let's go and check if the file is actually existing. Black-Scholes app or with the space here. Okay, understand, with the space. Let me now rename this and let's try to close this space here. Okay, when I close this, you see there's no longer space there. So it's Black-Scholes app.py. Okay, let's do it again. So, oh, by the way, I need to copy the file path. Copy the file path, then go back to, then now I'm gonna say Streamlit run, Streamlit run, the quotation mark, paste the file path. Then after that, let me call the app. So it's called Black-Scholes app.py. Now let's run this. Initially it was saying the app does not exist. I'm saying the file does not exist. The file does not exist. So let's now run it. You see now it say you can now view your Streamlit app. So it's still running now. It will automatically open the app so that we use it to make the prediction. Let's just give it some time in uploading the app, ladies and gentlemen. So it's still running. It's still running. Let's just give it some time. You can see it here. It says it's still running. Okay. Okay. Let's give it some time so that it complete the running. Okay, now you can see that it has displayed, you see, still displaying the results. So this is the app that we actually create. Remember we said by default, it must set the strike price to be 100. The strike price should be 100. Stock price should be 100, strike price 100, time to maturity, risk-free rate, volatility, and also decide whether it's a call or a put. So let's try to make changes. You see that this year it has already predicted the European call option. So it has predicted the European call option already. Now, in terms of this, ladies and gentlemen, what if at the same value. Let's try to change the values now to actually observe what would be the result in terms of the prediction. Right. Remember initially, what did we say? For example, we said in the previous example, what was the strike price, by the way? Remember, the strike price was 100. I mean, spot price was 100. Strike was 25. Maturity was half. Risk-free rate is 0.02, and the volatility is 0.01. And I think the amount was around 70 something. Okay, but for a call, let's just try to make changes here. Let's make changes and change the strike price. Let's say the strike price here is 25. Time to maturity 0.5. Risk-free rate, let's say 0.02. Volatility is 0.01. Then you can easily see that for a European call, it says it's 75.2488, and it's the one that we have predicted earlier. But what if it's a put? For a put, it means I'll only change here for a put. I'll only change this parameter to say this time around, I want this to be a put. You see, for a put, it to say it is 00. Is the one that we said it is out of the money. It's out of the money. But now let's do the changes. Let's say this time around the strike price is 100 and the stock price is 25. The strike price is 100 and the stock, we see it's coming to 74.005. It's what we actually has estimated. But now let's increase this. Let's say the spot price is, let's say, 150, and the strike price it's just around 80. Then let's say for time to mature, let's just say for 3 years, and risk-free rate is 0.15. Volatility is just 0.05. And for, you see, for a put option, it will be 00. Why is it 00? Is because the spot price, stock price is bigger than the strike. So this is out of the money for a European put. But if we change this and we want this to be a European call, for European call, it will be in the money. It will be in the money, 98.9897 US dollar. This is for a European call option, for European call option. But how about if we increase the volatility? Let's say the volatility is around 0.09. Let's just increase the volatility only. See that by increasing the volatility, the amount it's not changing. But how about if we just say 0.10? Just an example. For 0.10, you see that the volatility is actually not changing. Then how about the interest rate? 0.20, 0.20, 0.20. You see that the risk-free rate actually increases the call price. So it means, okay, how about if the volatility is now 0.15? Then the value is not, it's not actually increasing. So even if we decrease it, let's decrease it. The value is not, but let's increase the risk-free rate to 8. The risk-free rate, by increasing the risk-free rate, it increases the call options. It actually increases the call options, ladies and gentlemen. So this is actually the app that I actually created in making the predictions by using the Black-Scholes option pricing model. So thank you for listening, ladies and gentlemen. Don't forget to like, subscribe, and hit the bell button for future video notification. Thank you very much. Bye-bye.